Welcome to the June 12th edition of Odds and Ends. I'm Dave Singh here with Rob Friesen, trying to get a start on the week here using StockOdds data. How's everything, Rob?
Yeah, not too bad. Thanks. We do look at other things as well besides StockOdds for our thoughts for the week, but it is a major building block. I've historically taught on really 6 pillars that we build our trading framework from, and they're not necessarily in this particular order, but just as a reminder, you may have heard of this from me before, or maybe it's new to you, but I really believe in a fundamental foundation or a fundamental backdrop. If a company has no earnings at all, to me, it's a very different investment prospect than something that has a solid stream of earnings and pays a dividend and so on. The problem with trading or any particular time frame that an investor or trader might enter is that the markets can run differently than those fundamentals. So you can have a company with no earnings, soar for years. But, when there's trouble, when there's challenges, that's when, we find out if the emperor has any clothes or not. Right? It's always been like that. But the problem is the in-between times where, everything is fine, it's a party, the Titanic was having a great party before it hit the iceberg, so it's just the way life is, especially in the investment world. So fundamentals, this foundation is important, and it definitely comes into play when markets are in a real risk off environment, when there's change there, right? The next one is statistical information, and we use this day to day, and that's where StockOdds comes in. And the statistical information covers a lot of the noise aspect of trading, which over the long sample, we see a lot more noise than we do see signal. I'll give you an example. The back and forth action that you can have in a consolidation zone or from day to day is more repeatable than a streak, even if you've had 5, 6, 7, 8 days in a row. It seems like a lot, but that doesn't happen as often as you get those back and forth days, the trading ranges, the consolidation, 2 days up, 2 days down, that kind of thing. So this statistics work reasonably well in the long sample of all of that activity, looking for the noise, but we also like to pay attention to the signals that can come from other things. Then you have technical considerations. So those would be like, you see a support level that's actually been produced by traders and investors. You see a resistance level that's actually been produced. So these levels are important, and we call that technicals. And trends and trend lines and moving averages and things. It's all part of it. But again, you can't hang your hat just on one item. So technical considerations, if you can use them to your advantage, if you can create if-then statements, it's great. Then we have historic observations. These are relationships and things that have stood the test of time, that if this occurs, then generally this occurs. This stock tends to be very sympathetic to this stock. It tends to track with this, right? And then we move into sentiment. And sentiment is, kind of like a voting machine. It's not like things are equally weighed. people have love affairs with certain stocks, and they hate certain stocks. They all think the world's great or it's terrible. We're now fighting many different fronts of changing sentiment, and it's getting worse as inflation persists and interest rates rise and other things get affected, asset classes decline. It does affect sentiment, and that takes some time to reverse back to where you get an optimism happening again. It doesn't happen overnight. It may seem like it does when we suddenly get a bear market rally. You may think, everything's changed, but that doesn't mean sentiment's changed. It just means that there was a appetite to pick up some stocks at a discount that particular day, and it fed on itself, and algos fed on that, and people didn't want to miss out. But that might still be hot money and weak hands, right? When sentiment truly changes, then you're going to have stronger hands. And then you have the sixth one, which is macro influences and all that goes with it globally, and then also news on specific, stock-specific news, industry-specific news, sector-specific news. So we put all this in the macro and news category. So all those six matter, and not necessarily in that order, but that's how we view things. And so we like the statistical approach, and we also add in a few other ingredients to give ourselves a better fit. And we're going to try to put a bit of that in today with looking at different things. I'm going to flip it over to Dave at the moment here to just, where are we at with the futures since they opened at 6 p.m. Eastern time?
Yeah, it's a bit of a risk-off mentality here. The Dow's down 0.97%. The S&P's minus 1.33%, and the Nasdaq's the worst at minus 1.8%, and the Russell at minus 1.4%. So it looks like it's just a continuation of the kind of theme we had on Friday, with the Nasdaq a little bit worse than the S&P, and then oil is down about the same as the S&P. So the S&P is down 1.33%, and oil's down about 1.4%. So it's not like oil's crashing down. But Bitcoin is down quite a bit. So again, confirming our risk off. But 8%. Right?
Yeah, and normally over the weekends, Bitcoin has often traded, and done a lot better. It's had some dips on weekends too, but generally, my observation has been is it's been trading stronger when the stock market's closed, and it tends to get under some pressure with the stock market, only because the stock market's been selling off. Most of the weeks since January, we've had some up weeks, but not as many up as down. And so overall, I think Bitcoin and some of the other cryptos have just been declining along with the stock market. Yeah. But when the stock market's closed, sometimes we get good rallies on the Bitcoin, right?
Yeah, and Ethereum is close to 10% down. But the VIX, we opened sharply up when the futures opened, and it's been grinding higher. So we're now above 30, around 30. And last week we got close to 24, 25. So that's a big change in the VIX. And it seems to be like conditions are deteriorating because it is grinding higher in the background there.
Yeah. So, I think we're in a situation where, good news is bad. Like anything that, where the economy's firing on all cylinders, where, we've got any sort of hints of more inflation kind of being priced in, like wages rising, things like that. Mm-hmm. So, strong economic data is actually bad at this particular junction because, the inflation is a serious thing. And it's surprising that a lot of economists have missed it so bad. Like, they were surprised with the CPI numbers and they missed it on all counts on Friday. And so we're now seeing that Barclays is calling for the Fed this week. So Wednesday is our announcement day, and they're calling for the Fed to raise it by 75 basis points.
Mm-hmm.
And, 50 is a given, right? 50 is for sure. We know that because Powell already said that. I mean, it's going to happen. 50's on the table. But 75, Barclays is saying. But, that doesn't mean everybody's agreeing with that, and doesn't mean the Fed will do it. But if they were to do it, I think it could send a significant shock again, because we haven't been pricing in 75 for this one. And the odds makers have been pricing in a 50-50 chance of 75 in July.
Mm-hmm.
So that's the next meeting. So again, for that one, 50 is a given as well, but they're calling for maybe 75. So there's some stuff starting to change here. And that just means, well, wait a minute, if our models are kind of off, we've got to factor in more risk. We've got the 2-year already at a 15-year high. It's going to create additional strength in the dollar. So, that affects international stocks differently than domestic stocks as well. We've got the 10-year yield now at 3.19. We've got the 30-year mortgage is now up at 5.85%. So
wow.
It's creeped up. Overall, as I scan through the news over the weekend and coming up to now, it just seems like there's more and more, negative. Like, I think there's a significant negative force in play, which has to just play itself out. We had last week was the worst week since January, and we've had so many, down weeks already this year. We don't have a full-blown, yield inversion yet. The 2/10 is still positive, but we've got a little bit of yield inversion going on some of the other time frames, but not to the point where you could say it's definite that a recession. So this is going to be this battleground of whether we're going to have a recession or not. So the support level is around 3,400 if things just play out the way they are. If we go to full recession, GS is saying 3,150 on the low side. So there's some serious room to still move lower, right? So anyway, this is like, didn't we have a podcast and I said I wouldn't be surprised if we erase all of the stimulus, that we had since, 2020 kind of thing? It wouldn't surprise me in the least to erase it all. I mean, that's what bubbles do. It's like when you blow up a balloon and you pop it with a pin, what happens to the balloon? It kind of returns, if it doesn't shred, it kind of returns to its original shape and size. It goes back, all the air comes out of it, right?
But that would be pretty remarkable for us to go all the way back to that 2020 level.
It's possible because, I mean, it's just a matter of erasing all of the benefits and the policies of that stimulus. And, it's not the first time we'll see a bubble, disappear, and we go all the way back down to where we came from. So I think we're just fighting a pretty serious deluge of bad news, and then this problem with good news is bad, like strong economic data, and then we're facing, having to readjust for maybe more significant Fed action if they head that way. If they only do 50 instead of 75, and the market starts already the next 2 days to price in 75, then of course we could see a relief rally out of that, right? Mm-hmm. So that sends me over to you with mid-month seasonality. Can you talk about what we see, because it's starting tomorrow, right?
Yeah, it's the 9th, 10th, and 11th business day of the month, which starts tomorrow. And so this S&P, the spider, is expected to do plus 0.42 for the mid-month. And so are the diamonds, which is a coincidence. They're both exactly plus 0.42. So I did a screen a little bit earlier to look which ETFs are expected to do better than that and which ones would be worse. to find things that maybe to go longer or shorter relative to the spider. So the longer ones are things like healthcare and biotech, XBIIBB, real estate, small caps with the IWM, utilities, chips, the QQQ, consumer discretionary. It's even got XLC, XLK, utilities, healthcare. So a lot of stuff is set up to do better than that during the seasonality window. And the things that are short, expected to do worse, are shorter: silver, gold, materials, energy, financials, industrials, and staples. So it's a mixed bag of things that are expected to be up and down. But I think the themes would be health, biotech, small caps, chips, QQQ, technology, things like that to be longer during the window. But then when we look at our futures for tomorrow, I mean, do we really want to be longer technology? Right, that's Nasdaq's getting hit the hardest already, and we got hit pretty hard on Friday as well. So the major de-risking is hurting the Nasdaq and technology more than some of the other sectors. So it's a little tricky there.
Right. So we should look at like what are the actual support numbers coming up here on the market ETFs themselves, which is what most people are referencing. It just doesn't surprise me if we want to go and test the May 20th reversal day on the diamonds. We had a low of 306.28, and we stopped on Friday at 314.37. So we have a little ways to go to test that, but it wouldn't surprise me at all, because this is what generally tends to happen is when you get strong inflection points where many people might have capitulated on volume or tried to get back in, and you had a real reversal. Those become key numbers, and when the market is heading that way, it's really like a hive sentience that wants to go and test it. It just does. It just wants to make sure that we can have something to lean on. So I don't think it's going to be happy until we get a solid test of that. Let me put in the SPY here and see what that number is. So the low on May 20th was 380.54, and we're at 389.80 on the close on Friday. So that's not that far to go. You could factor in how much we're already indicating down and see if we're in the zone to hit that already. So tomorrow will be important as in terms of where we're actually opening. What happens in the overnight futures? What happens pre-market? Where are we actually opening? If we're opening at support level, you could get a bounce, right? So it's what we're talking about now in terms of factoring in that we can go test it. You might actually be there. So just keep that in mind. We had a significant gap on Friday from Thursday's close to Friday's open, already a significant gap. So we can cover ground very quickly when people are wanting to get out of stuff. And they generally make the mistake of getting out at the wrong time. This is a historic situation that we see repeating itself. Just to move over to the Qs and check them. We've got a low on May the 20th of 280.21, and we closed at 288.84. We actually had a higher low that was good at 282.25, so a couple points above that. So that range down there, so not as big of a distance as what the diamonds have to travel, but we're closing in on that. And then for the Russell IWM, you got a long way to go to get to the May 20th low. Actually, May 20th low, we don't need to go there. That wasn't the low. So the low was May the 12th for the Russell. So it was out of step with the other markets and hit it on May the 12th for 168.90. And so we're about halfway from the recent highs down towards that low. So we may not we may not have it traded all like the other markets. So just keep that in mind. Diamonds should be the most defensive, just because you're talking the Dow 30 and their lower volatility generally. The Qs should be the one that moves the most, right? SPY's next. Okay.
Well, the other pressure on the Qs is the 10-year. So I think we're above 3.18. I think 10-year Treasury 3.19% right now. So it keeps rallying. That's going to put more pressure.
Let's talk a little bit about how we kind of line up some of the building blocks that we were talking about, the foundational principles. So, for example, if we take a market like the Dow 30 and the stocks, and we were to divide them into longs and shorts, we, on a statistical basis, we would have 22 longs and 8 shorts that would come up for trading if you wanted to use every symbol. And that just, what that's taking into account is the entire move of how we got to where we were on Friday and what that means in terms of the potential to sort of have a reversal. Now, those stats are based on what has historically happened on average over the last 2,000 days. And, that's quality information. It doesn't know, however, what's transpired, let's say, over the weekend, what new news has come out, what other shoes are dropping. And so it's good. So we have 22 symbols long and 8 short. Of the 8 that are short, a couple of them are consumer staples, which, if you're having a risk off type of day, they're probably going to be stronger than, the technology stocks. And in the technology stocks, we have about 8 of them, I think, that are 7 or 8 of them that are, of the 22 that are longs, 7 or 8 of them are technology stocks. So those aren't the best for a risk off day. So here's how I would prepare. I would actually prepare the Dow 30 lists 2 ways. One is a risk on, and one is a risk off. And the reason I say that is, if you were to be opening down at support with a very significant overnight gap from the close of Friday to the open of Monday, and you were to open at that level, there is a chance that they kind of discard the defensive posture and actually buy some of the technology stocks. And with the yield moving the way it is, maybe buy some financials and things like that, right? And then the other approach is to have more of your longs that you want to buy more defensive, and split a little bit better between longs and shorts rather than 22 longs and 8 shorts. So if you're opening with some distance still to travel to be able to test the May 20 low, right, on the diamonds, then it's better to be defensive. If we're already opening down at that level and there's tremendous potential to bounce up from there because you tagged it, then you would want to be in things that are a little bit more risk on. Does that approach make sense, Dave?
Yeah, that's a good strategy.
Right? So it doesn't take much to take and to prepare things 2 ways. It's a little bit more effort, but again, it's not that bad. So, of the components that are in the Dow, so which groups are favored from there that you would say, this would be part of what should happen this week?
Well, mid-month seasonality favors like things like NASDAQ, technology, XLK, discretionary. The risk-on stuff is favored according to the mid-month seasonality.
So that would play well if we opened down at that level, and then we had our risk on list. It would match the seasonality, and you could say from a technical perspective, it's a good trade as well because we have support. And so what would work against seasonality is that, you know, this banter of recession, this you know, odds making on the 75 basis point hike, if that increases between now and tomorrow, or you know, for this week in general, and then the Fed actually does that 75, I think it's going to wipe out seasonality, meaning that we're going to be much more defensive and totally risk off for the week.
Yeah.
See, this is the tension that we have to deal with as traders, right? And you're never going to have, it's not going to be perfect. There's a lot of confusion. You know, nobody has a good compass. You hear a lot of voices, a lot of talking heads. And I really like to take a statistical approach so that I understand that what happened on Friday or in the last many sessions, this is what is most likely to occur next. And if I can match that with some other things, you know, to line up some ducks, that's really beneficial. And it does line up with seasonality if we take the approach that, you know, we can have exposure to technology. So again, just repeat what, from a seasonality perspective, groups, what sectors can we have exposure to for this next 5 days?
Technology, consumer discretionary, healthcare, communication services, and chips, and utilities, right? And real estate.
Yeah. Now let's say it's going to be a crappy week. Everything's going to bust loose to the downside. Okay. Now what groups? From that perspective, what groups would you want to be long? Just say the long ones.
According to mid-month seasonality, or just?
No, just according to it's going to be a terrible week.
Oh, well, you want to be in your utilities, healthcare, staples, maybe real estate. I mean, those are probably the ones you want to be.
Okay, so you just named an overlap, healthcare.
Mm-hmm.
So healthcare would be considered neutral under both conditions, mid-month seasonality and a terrible week. Right?
Yeah.
Okay. So that's you kind of want to find your Switzerlands, right? You want to find your Switzerlands because that can help you. You know, you can do this. You can choose to just play in those groups with a couple. You could take healthcare, for example, and you could go to StockOdds web screener, and you could just take the one S&P 1500 healthcare and choose some great odds for the long side in healthcare and some odds for the short side in healthcare, or use the ETF.
Mm-hmm.
That puts you into Switzerland long and short hedged. So I have to say this over and over in all of our education and events and meetings and whatever, is that when it's risky, when you're not clear, when things are very confusing and lots of news coming from all angles, it's better to focus on, you know, finding a really low variance, balanced approach and take long and shorts that are going to help, you know, focus on the relative performance between the longs and shorts and not the direct market exposure or not the direct, you know, sector exposure either.
Mm-hmm.
Okay. So remember, you can choose as much safety as you want, or you can embrace as much risk as you want. You're the operator. You're the CEO of your own trading business. It's up to you. When we kind of get a great read on the market for risk on and the world's a wonderful place and everybody is out wanting to buy, you know, you want to press on your groups, your technology, and things that perform really, really well. But that's not what's happening in these down markets. We're seeing a lot of pain. If you want long side exposure to technology, you're going to get run over. Okay. Mm-hmm. Well, I hope that helps. You kind of, if you want to do this approach, you kind of have to go to the smaller market, like go into the S&P 100 or the Dow 30, and then look at you sort it by group or sector exposure, and then go and select the best odds from each group, and that'll kind of get you pointed in the right way. And if you can find an overlap between mid-month seasonality and what's going on in the real world right now, then great. If you can't, don't be afraid that one can cancel out the other, and you won't always have that complement, because that's reality. We can plan for something, and the weather can change, right? Mm-hmm. Okay, so hope that helps. Anything else, Dave?
No, it should be interesting day tomorrow.
Yeah, again, it's really important where we open. What happens pre-market and where are we actually opening, and that will kind of set the tone for the day. But this whole week is going to become largely centered around the Fed and any other major things. The oil thing is still big. The China thing. I mean, they just kind of relaxed on some curbs, and now over the weekend they've gone back to full-on testing in Shanghai and Beijing, which are two massive population centers. So I mean, China's not out of the woods. We still got war. We still got other things brewing everywhere in the world. So fasten your seatbelts and get some rest, and we'll catch you guys next week on Sunday for the podcast, or during the week as we do our live shows with Joel Elconin. Okay?
All right. Good luck.
Thanks a lot.